Well, the 2012 outlook for mergers and acquisitions in developing markets is improving, with less than 60% of deals that undergo external due diligence failing. Simon Venables, head of transactions at PwC, joins us to talk takeovers. Well, let's talk about this topic. Very interesting. We see it happening here in South Africa, and we're seeing a lot of companies looking for growth when it comes to mergers, when it comes to acquisitions. But let's talk a little bit about how many businesses are still failing when it comes to just the common pitfalls to, in closing those deals and making sure that those deals go through.
Thank you very much. Yes, I think that what people need to appreciate is when you're doing deals in different territories with different cultures, different rules, I think you need to approach it in a much more thorough and more patient way than perhaps doing a deal in a much closer proximity with an environment that you understand. So I think one of the areas that people sort of don't appreciate fully is that deals are very, very complex. And I think there's lots of issues from human resources, regulation, logistics, funding, different legal environments that come into play. And preparation is absolutely key, and understanding of the risks and the benefits is absolutely critical.
When it comes to understanding, the market that you're going to be operating in, how important is it for a company, for instance, to go into a country, particularly here in Africa when you're talking about developing economies, and understand how that culture works, understand how the people operate, and just how business is done in those countries primarily?
It's absolutely essential. I think the way we see it, global clients moving into new territories, moving into Africa, which we can talk about with much more authority, need to understand the real opportunities, need to understand how people go about their business on a day-to-day basis. If you're not on the ground or not prepared to get on the ground and have good local input, you increase your risk of failure.
Simon, let's just talk a little bit about who's making these acquisitions and who's making these mergers. Are you seeing it more developed economies coming into developing economies, or countries, say within Africa, other African countries wanting to expand onto the continent?
It's a complete mixture. We see some of the largest corporates in the world buying into territories and into companies in Africa. We see other developing countries investing in Africa, resources, infrastructure, consumer, services, IT services. And we see African businesses, countries doing a lot more business with themselves. So I think we see a combination of all of those. So,
who's doing better? The developed countries coming in here, or African countries, expanding within the continent themselves?
I think it depends on if the technology base, if it's a technology company, you'd find it more global. If it's consumer-driven, infrastructure-driven, if you see people doing services in Africa, I think that a lot of people understand each other and understand the environment much better, find a lot more affinity in dealing with each other.
Now, one of the things that, I don't know if it's a perception or a fact, you can tell us this, that it appears to be much more risky to have these kind of deals in developed economies as opposed to developed economies. So when these players do come in, how do you manage that risk, particularly for a company that has not done this before, particularly for a company that has not operated in Africa before? How then do you work with them so that they could be able to understand some of the dynamics on the continent?
The first thing is to understand what the strategic rationale is for entering into a new country, a new area, a new region. To really understand that, because that helps drive the process there afterwards. It helps, for example, some companies might say we want to be in a particular part of Africa, so let's build a platform, small platform to start off with, and then we'll grow, from that once we get more appreciation of all of the issues. So that's one strategy. The other strategy is someone is exposed to a deal opportunity, and it's a pretty short time frame, which means they don't have all the time to think about those, all the different things. But I think it's very, very important that that strategic rationale, on the ground knowledge, what is actually happening, not what somebody, not a report that's that's been given to you, not a newspaper article, not a combination of third-party reference points. Actually on the ground, interviewing, talking to people, seeing where trucks go, seeing how people do business is absolutely critical.
So now the deal has been made. Now it's gone through. It's been successful. What is key for that deal to be successful going forward?
I think one of the lapses sometimes is a deal happens, people have a celebratory party, champagne, deals happened. Now the hard work starts. You've got to now make things happen. So that first part, so the post-deal period is very, very critical. making sure the people that are in a company feel motivated, make sure there's no cultural issues, making sure that your stakeholder engagement is really, really important and put into place, making sure that any partners you have, that you manage those relationships absolutely critically.
When it comes to some interventions that come in, say government interventions, that has been seen as problematic in some deals, you know, how do you even work with that? Because then you are talking about a force that's pretty strong in whatever economy that a company would be wanting to move into when it comes to acquiring that and making that deal successful.
I think we've seen that across the whole globe. It's not a phenomenon limited to developing countries. We've seen it across the globe. Government, it's a fact, government is more involved and more interested in M&A deals than they were historically. And I think it's very important when you're doing a deal to really understand what the government is thinking. Is it a job creation agenda? Is it a currency agenda? What is it that is really driving their mandate with the people? And if you understand that critically, it really helps with greater stakeholder engagement.
What deals are you seeing that are understanding that and are able to be successful when it just comes to working with the government? What kind of attitude and what kind of, you know, play, if you would call it that, is making these deals go through?
I think some of the companies that do deals in some of the smaller countries, for example, you know, their companies are massive. They're bigger than some of these countries' you know, GDPs themselves. So I think if you deal with people with respect, really understand what their economy is all about, understand how business is done, you know, take a bit longer, maybe be a bit more patient, and then work with them and understand how you could fit into your agenda what the agenda of the day is of the government.